So recently, a friend of mine asked how I know what companies to trade. And I think that that's a pretty common thing for people to ask. They ask about day trading and how do you know what to buy and what to sell. And at the end of the day, I don't do any of that. What I do is I try to run a business where I use stock options, ETFs, and stocks to develop an inventory, buy great companies, and then at some particular times, I will sell those companies for a profit. Oftentimes, I'll do that using puts or calls, and puts really are close to selling insurance, and selling a call is a lot like selling rent. So it's almost like being a landlord when you buy the shares and then you sell those covered calls. Though recently a stock caught my eye, which was Amazon. So Amazon had their earnings this week. One of the something pretty incredible happened is they actually met the revenue expectations, but they missed the earnings per share expectations. And there was this pretty precipitous drop between, it was normally trading up here at let's call it the 230s, and then it very quickly dropped down to this 209, 205. I gave it a few days just to see where this thing would even out. And then today, on the 17th of February, we had a little bit of an update. So that tells me that there is still some buyers left down at the 200 area. So one of the indicators I use is these stochastics. Again, I'm not a super technician. I know that some folks are phenomenal at trading on short notice. I typically buy for long periods of time, and I try to find good opportunities to buy. So when I see a drop that's as precipitous as this, and then knowing that Amazon is a great company, I try to take an action. So one of the things that I'll do first is I'll take a look at net income is one of the big indicators. Really, it's net income, it's PE ratio, it's total liabilities. But at the end of the day, it's income that's going to drive the appreciation of the stock. Is so long as the income is increasing, everything else being equal, the stock price is going to increase. So I see that since 2021, this is a yearly look to 2025. We've had over a doubling of the total net income. And so you see that over this time, even though over that same period of time, net income essentially went double, the stock price was still trading about 181. And as of today, it was trading down in the 200s, 201. So I thought this would be a good opportunity to build my inventory of Amazon stock. That being said, I don't necessarily want to drop $20,000 immediately on buying 100 shares of Amazon. So I'm typically going to do something like this. Now, obviously, this isn't financial advice. This is just something that I do. If you learn something from it or you get some coaching value out of it, that's great. But I'm not telling you that this is what any particular individual should do. So I go over here to Option Strat. I'll have a link down at the bottom. If you use my link, um, get 7 days of free trial. And if you end up going for the subscription, which I recommend, I get paid, I think like $4 a month or something. So here we are at Amazon. Amazon stock right now is at 201. Let's say this is actually after hours. I made this trade earlier today. So one of the things that I could do is I could just buy 100 shares at 201. It cost me about a little over $20,000. Or what I would prefer to do is I'm going to set my expiration date out here to January 27. I'm going to sell a put right here at 205. That put is going to bring me in $26.55 or somewhere thereabouts per share in that contract. Options contracts are in 100s. And with that premium that I'm receiving, I am going to go ahead and purchase a 215 call. So what does that mean? That means if the price goes above 215, over the next 332 days, I will be given the opportunity, because I'm the buyer of the contract, to purchase at $21,500 for 100 shares, or $215 per share. So why would I take this approach? Well, like I said, I could just buy today. If I buy today, it's going to cost me $20,000. If instead I sell a put, which will obligate me to purchase at $205 per share for 100 shares by January 27, if I sell this put, I'm obligating about a little over $20,500. But if I do it this way, I'm able to purchase these shares. And if the price goes up, which is what I expect, seeing the performance of the net income of Amazon, with the understanding that they have maybe not complete cloud dominance, but they also have an incredible amount of e-commerce dominance. They are innovators in this space. And generally, I like the story. Again, not financial advice. It's just a story that I like, and I like the price. I have a feeling that the price is going to increase. And so as it increases, you see it's flat here. So between this call and this put, I end up getting a little credit. So I put $115 in my pocket, and I wait 332 days. Now, as that time goes on, I suspect we'll get, prices are going to be a little bit volatile. They're going to go up and they're going to go down. One of the nice things about owning this call here is I can actually sell another call on top. So let's just say sell a call. I would sell it at a higher price than the call that I own, making this a debit spread, meaning the total value in here is something I would be putting out. I put this at about, let's call it 225. And then I would change the expiration from January 27 all the way back to, let's call it March. Let's see what March looks like. So if I move it back to March, it has a delta of 14, and I'm going to make a little extra money. That's an extra $134 if I sell this covered call. If it hits this number in that period of time, I top out profit at around $2,300. If it doesn't, I can sell another call later on for a different date. So this is probably the approach that I guess I'm not going to recommend it because it's not financial advice, as we said before. This is the approach that I'm taking personally. I haven't opened this position yet. I want to see if I can get a little bit of a bounce here in the price, and then I'm going to go ahead and start selling these calls that are covered by a long call position that I own. A lot of people refer to that as a poor man's covered call. I don't think there's anything poor about it, but I understand why they're saying it, because it's a cheaper way to execute that call. I think this is something that I'd like to see develop over the next year or so. And if you stick around, I'll definitely have a couple more videos on it. Thanks, everybody. Bye bye.